Our next guest was one of the first strategists to call for a rally back at the beginning of the year. Now it says we may have seen the peak with the S&P flatlining around 4,400, although we're obviously above that now in the second half of the year. Joining us here at Post 9 is Stifel's chief equity strategist, Barry Bannister. Barry, great to have you on set.
Great to be here.
Great to see you. I keep thinking you were zigging when others were zagging. Are you now trying to do the same?
Well, the second quarter really was led by the big tech, but we think the third quarter is going to be led by more what you call cyclical value. And this would be the banks, diversified financials, industrials, basic materials. They should give you a nice outperformance pop in the third quarter as the economy holds on.
So why not more aggressive targets then going into year end?
Well, I think that by the end of the year, our model is showing that unemployment's going to perk up. It's going to go up. And the Fed is going to hold on to a high rate longer than people expect. They have to ensure that inflation is down. They actually have to overshoot to the downside. And so if the Fed holds on, real rates go up, price earnings multiples come down, I think we get back a few percent in the fourth quarter.
Do you have give us a picture of how you see employment printing in the back half?
Well, I think it'll be 4.0% by the end of the year, and that's enough to push you towards a little closer towards a recession fear. And I think it'll be 6% by the November 2024 election. So when we look out into 2024, there are a lot of risks that are not being appreciated. We don't have the kind of earnings growth. We're almost flat year over year next year. The street sees it up $20 for the S&P 500 earnings. And I think oil is a great big geopolitical risk in 2024. Russia has a lot of incentives to reduce production and drive the price back up.
So then why would you buy cyclical stocks on the back of a spike in the unemployment rate and the Fed remaining restricted for a long time?
Yeah, that's a great question, Sarah. I mean, the thing about what we're in, and it's a secular bear market since December 30th, 2021, when the S&P 500 peaked, is that in a secular bear market, it's nothing but a series of short-term trades. Buy and hold is dead as a doornail, and it will be for probably 10 years to about 2030. As a consequence, you know, the second quarter dominated by big tech, third quarter in the more industrial, basic materials, fourth quarter could be a different story entirely. So we're going to have to rotate around the board.
So the cyclical trade is a rental, so to speak.
Oh, everything's a rental in this kind of a market. Yeah. If you look out to or look back to 2022, it was the stagflation trade, right? And that's not working now. But that was a huge trade. You made a lot of money in utilities and you made money in energy. But they're not working now. So what works is a rental and nothing lasts for long.
I feel like there's this big debate shaping up over 2024 already. I mean, you're sounding kind of downbeat. 2 minutes ago, we heard from Bruce Van Saun, the CEO of Citizens Financial, saying he thinks that banks are going to step up loans next in 2024, that the conservatism is going to fade. We're hearing all sorts of bullishness and green shoots in the investment banks, that we're going to start to see deals in 2024.
Well, the economic surprise index beating by such a wide margin is because we lowered the bar so much. As the economy bumps up against resource constraints, as you get into 2024, inflation becomes a little more entrenched. We actually think the core PCE deflator is going to stay around 3%. And the Fed is saying 2%, which means I've got to get Powell's Fed from 2 to 3 and accept that on a longer term basis. And that's going to be a heavy lift.